The week ahead. Let me start off with a very mechanical approach. The profile in front of you shows the afternoon pullback low. Short-term trading is about change. If there is any change relative to Friday's rally, the market will find acceptance back down below the afternoon pullback low. That's the reference that I'm using to see if Friday's rally starts to give anything back. But let's take a different look at the market. Last Friday, prior to the opening, we offered a public webinar titled Short-Term Traders' Biggest Risk and Current Market Update. The reason we used the title Short-Term Traders' Biggest Risk was because MGI, or market generated information, indicated the market was in the shortest inventory position I had seen in the last 10 years. This assessment was based on 5 non-excess highs and 1 weak high over the last 3 weeks, along with constantly declining value. The significance of the combination of non-excess and weak highs was that this was most likely the behavior of the shortest time frame traders. This is the time frame that is most likely to continually lead to inventory being out of line or being too long or too short. While Friday's rally relieved some of the short inventory pressure, short inventory remains. One day relieved a lot of pressure, but certainly not enough to bring the inventory back to balance. Additionally, Friday's rally was likely accentuated by over-aggressive selling of naked calls as the market declined over the past several days. Naked call riders are in the same position as short sellers. I have been on record several times over the years as saying the riskiest strategy, in my opinion, is the selling of naked or uncovered options. In recent weeks, the market has focused heavily on earnings. For all practical purposes, earnings season is over. With earnings seasons over, that's going to shift the attention to Fed speakers as well as economic releases. This week, I expect to see a high level of volatility, starting with the Chairman Powell's testimony in front of the Senate on Tuesday, and then on the following day, he testifies in front of the House. Additionally, on Wednesday, we will see the release of the Fed's Beige Book. All of that is leading to the employment report, or the monthly employment report, on Friday. This report will be watched very closely. As you recall, last month's report greatly exceeded expectations. The market will be looking to see if this continued or if it was kind of an anomaly, and a weakening report would show that the Fed was achieving their goal. I have no idea what those numbers will be, but I do think that they will be heavily watched. I think this is going to be an extremely difficult week for traders. For those that can leave their biases at home and just trade on market-generated information, i.e., reading the expected volatility in the market, it could be a very good week. For those that are locked into a bias, either a long or short bias, it could be a very challenging week. Let me say good luck, and I expect volatility in the week ahead.